see them on the screen also?
Yep.
Right.
Sorry, Kumar. Just had a question for you. You know,
Okay.
Like every session that we do,
Okay.
like say last week's session that we did. Have you got like a set of notes?
Yeah, I can. I will send you the notes.
Yeah.
Yeah, I'll send you the notes in addition to the recording. I'll send you the notes. Yeah. I mean, basically, I have a note. Normally, I send it in advance, but I was not doing because too much of reading is also not, can make a little bit tired. So, generally, I say go to the textbook, but I'll send you the notes after that.
Yeah. So, like, if you could send, not like the combined notes, but like, like a summary thing.
I know. I'll do something. Yeah, but I know what I mean, basically a revision kind of a thing. A little bit of summarized note. So yeah. Give me time. I'll prepare something. I have the whole note, but I'll try to extract something and send it to you all. Great.
Okay, no worries. Thank you.
Yeah, great. I'll do that one. Yes, that's a good thing, I think. Yes. So, shall we look at some of these questions on the screen? That is on the area what we did last week, right? About the formulation of financial strategy. So, this is the typical kind of a question you might see on your computer screen on the day of the exam. So, first of all, a steady increase in earnings is most likely to be the financial objective of, they have given us a couple of things. A charity, a public listed company, a public sector enterprise, a not-for-profit company. A steady increase in earnings is most likely. Now, what I want you to understand is, before we really think of the answer in the question, right, you can see the steady increase in earnings is the objective of all these things. Charity also you need to have a steady increase of earnings. Public listed company also you need to have steady increase of earnings. Public sector enterprise also you need to have steady. Not-for-profit also you need to have a steady increase of earnings. But the question is the most likely. That makes a difference.
Yep.
That makes a difference.
So it'd be a public listed company.
Public listed company, because most likely, because for them, that is their crucial objective, I would say. So now this is the kind of question you will see. I mean, you will see all four are almost the right answer, but you have to select the exactly the right answer, and the key word that you have to look at is at most. The most. And that is what the answer is. You are right. So shall we look at the second question like that? Right. A public sector college receives government sponsored for certain courses with teach skills which are needed locally in the form of a fixed fee for each student completing such courses to a satisfactory level. The college operates very tight budgetary cash con. So even though these are little questions, Majed, you have to understand the scenario.
Yeah.
Don't try to just answer, but understand the scenario between that. Now here it's a public sector college which is receiving government sponsorship. So it is a government that is giving the money for certain courses, right? Which skills teach which are needed locally in the form of a fixed fee. Teach skills which are needed locally in the form of a fixed fee for each student completing such courses to a satisfactory level. The college operates within very tight budgetary cash constraint. So here now you can see they are asking, they are given 1, 2, 3, 4, 5. Which three of the following would be the most important again in a value for money review? So remember we talked about the value for money. That is economy, efficiency and effectiveness. So which are the three the most important in a value for? Yeah? What do you think?
Student achievement level?
Yeah,
student achievement level is one.
Yeah, that is because the effectiveness is right. Ultimately, that is what you should be looking at. You are right, student achievement. Now that's a good way, right? Try and see whatever you know, go and pick it up first of all. Yes, good.
Cash deficit avoided.
Cash deficit avoided, which is good because they have to work within the budget. Right? They don't have any other way of getting money, so they must work on the cash deficit avoidance. Yes.
Efficiency,
right.
Economy. Effectiveness.
Yeah. What else you should be? Now you can see. Now you can see the other three are also very, very important. Number of students enrolled, right? Cost of providing tuition, which is a very important one. Student achievement level already we have done. Student satisfaction with facility. But between those three,
yeah, it would be student satisfaction with facilities.
yeah, student satisfaction could be, but think about the other one what you are going to drop. The particularly the cost of per student of providing tuition.
Yeah, because I basically the reason why I said student satisfaction with facilities was because we've done economy, we've done effectiveness.
Okay.
The other one would be efficiency, because if you didn't meet like student satisfaction with facilities,
Yeah, right.
Essentially they could go elsewhere.
Yeah.
And also then the government funded would be cut because there wouldn't be as many students coming to that college.
Arguably you're right, but the only thing is what they're asking is not really the to identify what is economy, what is efficiency, what is effectiveness. You know, but they're trying to identify, ask is what are the most important inner value for money review. So in fact it can be two economies, two effectiveness, or whatever it may be. So whatever.
Sorry, if that's the case, then I'd go for cost of providing tuition.
Cost of providing tuition. That is what I was trying to explain it to you. Now this is why I am doing this question, because normally our mindset maybe we have to decide on one each for the each. No, that is not really. What they ask it is the most important value for money review. So you may have two effectivenesses, right? So I think the answer for me will be the cost of providing tuition and student achievement level, and also the cash deficit avoided.
Yep.
You have to think, if you are running this organization, these are the three things that you will be really working hard. Yeah?
Yep.
So the next one, let's look at it. So the next one also. Which of the following best describes the role of competition authorities? Right? So which of the following best describe the role of the competition authority? So they are given us that. So now there you can see the question. Which of the following best describes the role? One role they are asking. They are not asking for the roles. So you have to get into the question and see. But which describes the role of the competition authority? So number one role, to ensure that new business can grow and become successfully despite high levels of competition. That is not the role of the competition authority, or that is not the best role. To promote fair and ethical competitor behavior. To prevent monopoly situations developing in essential service industries. To ensure healthy levels of competition and safeguard public interest.
Yeah, you could argue it's basically between number 2, 3, and 4, but it's number 4.
I think
I'll go with number 4.
You're right. Now that is a good, excellent way, because you can see all 4 almost you can argue with, except the one, I think. I mean, they are not interested in whether the company can grow or not. That is not the one of their concern. But to promote fair and ethical competition, yes. To prevent monopoly situations developing, yes. To ensure healthy levels of competition, yes. And that is the most or the best one. So this is what I saw in these questions. The tricky part is that, looks like everything is okay, like, and to get the right thing out of that is something that we have to really work it out. So let's look at the next question that they have. Which three of the following strategies are most likely to enhance the shareholder wealth? Now that again, which three? So we have to get 3 items. So, which is going to enhance the shareholder wealth? Investments in projects with positive NPV? Yeah? Why do we invest in? So, definitely it is that, isn't it? We invest in projects with positive NPV because that is going to increase the shareholder wealth. Increasing the rate of dividend growth. Enhancing brand reputation and recognition. Increasing directors' bonus. moving profitable organizations to low tax regime. So now, some way that you can think of is there are certain ways we can eliminate something. Surely increase in director bonus will not come.
Yeah.
Because that is not going to increase the shareholder wealth. In fact, it is going to reduce the shareholder wealth. So I can eliminate that one. So investment in projects with a positive NPV, yes, I'm right. Increasing the rate of dividend growth, enhance the brand reputation, and moving profitable operations to tax low regime. So out of that, I have to select 2 now. So there again, I can say moving profitable operations to tax low regimes is a good thing, because that is going to reduce my taxes, that is going to increase my earnings, which is going to increase the shareholder wealth. So that is also right for me. So now I come between the 2 things: increasing the rate of dividend growth, increasing brand reputation and recognition.
I would go with enhancing brand reputation and recognition.
Yeah, right. Because the dividend is because it is the earnings that is going to increase your shareholder wealth, not the dividend, right? Because dividend is just money going out from one pocket to the other pocket. It is the earnings. So to increase the earnings, the enhancing brand reputation is the right way to go ahead. Right way to go ahead. So these are four questions which I picked it up. So like that, we will be looking at few questions every time before we start on a new area, and because this is going to crack your brain, and we will get an idea of the kind of questions that we will see it in these papers. And later on, I will send you some questions for you to do it by yourself, which will make it more challenging for you. So today, our subject is going to be about performance analysis. So we are going to look at the subject called performance analysis, right? So first of all, let's talk about this performance analysis in detail. Now, whatever we do, both now you as an investor and even as a lender, you would want to appraise the performance of the organization. You want to evaluate the performance of the organization, isn't it? Right? You may be already an investor, or maybe you are going to invest, or maybe you have given some money to me, to my business. So whatever it may be, one thing that you want to do is you want to evaluate. So the information what you get mostly is your financial statement. Now financial statements alone is not good enough for you to do a good evaluation. So that is why. So first of all, because we have to see whether finally we are achieving the objectives. And to see whether we are going to achieve the objectives, we have to see whatever the financial decisions we have taken. The financial decisions, you remember what we take? We take investment decisions, we take financing decisions, and also we take dividend decisions. So we want to see whether the impact of those financial decisions on the organization result. Ultimately, whatever the decisions, okay, we decide to invest on a new project. Is it going to increase my shareholder wealth? I want to take a loan. Is it going to reduce my gearing or whatever cost of capital or whatever? So basically, every organization will have to do some kind of a evaluation. And the key to do that one is to the ratio analysis. So this is actually something what we have learned already in the F2 area, right? Not too much of a big thing, but already we have done a lot of work in the F2 area. So this is just to back up with your F2 knowledge. So ratio analysis. What do you mean by ratio analysis? You work out the ratios, but the ratios only will become meaningful if it can be compared with something, right? Now, if you say my return on capital is 25%, it does not make any sense. It does not make any sense unless you can compare that with something. So just a ratio saying I have a GP margin of 15%, it's not good enough. You have to compare. Now, what are the comparators you may be having?
Prior year, comparing to other companies.
Yeah, you're right. Yes, compare with the other companies. One of the big comparisons you always do is with the previous year's figures. You can do 1 year, you can do another year, you can go on doing it for a couple of previous years, and that's one way you do a comparison. And you can always compare with, as you rightly said, with another company, right? What else can you compare? Normally in our businesses, where do we compare?
The
budget, isn't it? Because, isn't it? Because, basically you have set up your targets based on a budget. I want to achieve a 100 million sale, and if that is done only, I will get a 20 million profit. So I want to compare with my budget. That's another comparison that you will probably want to do it. So like that, there will be comparison could be between past periods, against budget, between divisions, right? So you may be having the same operation in two different countries. You may want to compare that one. Or maybe two production divisions. You may be wanting to compare between the two divisions or between two industry firms. And the comparison, once it is done, it is only going to give you some kind of a tool. It must be properly evaluated. Don't try to come to any conclusions by talking about the ratio. Now, for example, in UK, your interest rates are comparatively low compared to a country like Sri Lanka. Right? So the interest rate has some kind of an impact on the return on capital you will expect. Now, in your country, maybe the interest rates are something like 6%. Right? So you will be quite happy if you can invest in a business and get about 8% return. 8 or 9 or whatever. Right? You will be quite happy. But in Sri Lanka, the interest rates are something like 16% or 14%. So, if I get 10%, that is not good enough. I should get about 16 to 18 to 20% return on capital. So, what I'm trying to say is, if we try to compare our two companies and say that, Majed's company is only getting 8% return on capital, Kumar's company is getting 15% return on capital, and therefore Kumar's company is good. No, that is wrong. That's wrong. Because the circumstances in Kumar's country is different from Majed's country. So because of that, you have to compare, and that is why we say you must compare apples to apples. Don't compare apples with oranges. So comparisons before you do, sometimes in the examination also you may have to do certain adjustments and bring it to the same apple level or same orange level before you compare. So this is one tough task. Even in the same firm, maybe last year you have prepared the financial statements in a different way and this year in another way. You remember in your F2 you would have come across an accounting standard for the earnings per share. So the number of shares would have gone up last year to this year. Maybe it's purely a bonus issue, bonus shares, free shares, and that is going to increase the number of shares. But surely it is not going to increase your earning. So if you compare the last year's number of shares and this year's number of shares and divide it, that's not right. So you have to do a lot of adjustments. The comparators must be adjusted, and that is a skill that we have to develop, and that's a skill that probably we will be developing while doing some other question. So the comparison should be done on equal footing. Who are the people who are going to use the ratio analysis? In a nutshell, in one word, can you say who are the people who will be using the ratio analysis, Majed?
Stakeholders.
Yeah, that's a good answer you gave me. Stakeholders, the people who are having an interest in the strategy. So there are different people, and they would want to put it in a different ratios. So the investors, so they are concerned with certain ratios. Because the investors are concerned basically with your returns and the risk. How much risk these fellows are taking and how much return. Higher the risk, you will expect a higher return. That's a primary principle on the FT is working. Higher the risk, higher the return you will expect. And the ratios that they will be interested in, we are going to look at some of these ratios in a moment. Dividend payout ratio. What is the dividend payout ratio? What does it tell us? What is the dividend payout ratio? Yeah?
The amount of dividends that will be paid, and it's just...
Yeah.
the amount of dividends that will be paid.
It basically depends on, now the company has made a, shall we say, a profit of 100 million. Profit after tax, after paying all your interest, every taxes, everything, you have made 100 million profit. And out of that 100 million profit, the company decides to pay 40 million as a dividend. So the dividend payout ratio is basically the amount that you are going to pay as a dividend against your earnings. That's what we call a dividend payout ratio. So multiplied by 100 will give you a 40% dividend payout ratio. So some companies will try to maintain the same dividend payout ratio. So, okay, when they make 100, they are going to make 40. Next year, if they make 150, they will make a 40%. That means 60 million as a dividend payout. So the investors would like to see what is the company's policy on dividend payout. Are they going to pay a 40% dividend payout, or are they going to pay 20% dividend payout, or are they going to pay 80% dividend payout? So that's something which you will be interested. Then gearing. What is gearing? We have come across gearing all the time in our business world. What is gearing?
Gearing is
yes,
the amount
yeah,
the amount of equity against equity against lending.
The ratio is taken debt divided by debt plus equity. Now, if you look at, if you remember the statement of financial position, on the left hand side, you get the debt plus equity. Debt plus equity is how you fund the company, right? So let's assume that the debt plus equity is 200 million. And out of that, debt is, shall we say, 50 million. Debt plus equity is 200 million, debt is 50 million. So this as a ratio will tell us, right, what we call the ratio that we have a 25% gearing. What does that mean? It means out of your total funding, 25% is coming from debt capital.
Yeah.
So that is what the gearing mean. So gearing suggests, it says if it is a 40% geared company, that means out of our total funding, 40% comes from the lenders. Or the capital on which we have to pay interest. 60% of the capital has come from people of the equity where we don't have to pay interest. That's the thing. So that's a very important ratio for the shareholders. We'll be talking little bit on the P ratio, EPS and ROC in a moment. So let's proceed with the other ratios and see what the other ratios are like. So who are the people who will be interested in these ratios? So lenders, they will be concerned with the receiving payment on time. So they will be more worried about what we call the interest cover. But how does you calculate the interest cover? So the company makes a, shall we say, profit before interest and taxes. Let's say that the company makes a profit before interest and taxes of 75 million. So this is profit before interest and taxes, before paying the interest. So let's assume out of this, the interest amount or the financial charges is 15 million, right? So the interest cover is calculated 75, the profit before interest and taxes, divided by 15, the interest what you have to pay. So it gives us a cover of 5. It gives us a cover of 5. What does it tell us? What is it telling us when you say the interest cover of this company is 5?
It can cover it 5 times.
You can cover it 5 times. Yeah, exactly right. You can cover it 5 times. So the lender is safe for 5 times over their interest. Lender is safe for 5 times over their interest. If the interest cover is just 1, that means the lender has very little security or very little safety level. But when you have 5, you are fairly safety. So this is some condition. Sometimes you remember we were discussing on the constraints of financial sector, some of the debt covenant. The bankers might say you can't pay a dividend unless you have an interest cover of 5 times. So you have to maintain. So that is why the directors, even the directors will be interested in these calculations, because they have to work out on the financial strategy. right? They can't pay a dividend unless they have an interest cover of, say, shall we say 5 or 6 or whatever it may be. So, gearing also, why should the lenders be interested in the gearing market? Why do you think?
Sorry, could you say that again?
Lenders, yes, I told you gearing is, it is total how much the lending fund has come to the company. So why are the
if a company is highly geared, lenders wouldn't really want to increase, it wouldn't really want to lend money to them.
Yeah, probably
they're heavily geared.
Yeah, right, because they might think it's more risky for them to give money to the company, isn't it? Higher the gearing, the company becomes risky for the lenders. Higher the gearing, the company becomes risky even for the equity holders. Do you agree? Higher the gearing, the company becomes risky even for the shareholders, because, say, if it is 40% geared, you only have to, out of your money, you have to say that you have to pay that 40% people the interest and the balance is available for you. But if the company is geared 60%, you have to pay the 60% people before you are entitled for any dividends or anything. So higher the gearing, the company is becoming risky for the lenders, is becoming risky for the shareholders. Operational cash flow. Now this is something that we generally talk about. What is operational cash flow? Operational cash flow is basically, yes, in your IAS 7, in your accounting standard, you come across cash flows generated from operations. Yeah. So it is
would operational cash flow basically be the it's not the ratio where you get.
No, it's not a ratio. It's not a.
Okay.
It's not a ratio. It's a figure. It's a figure, right? It's a figure. It is a figure. If you remember your IAS 7, the statement of cash flow, there are 3 compartments. One is the cash flows generated from operations, then the cash flows from investing activities, cash flows from financing activities. So the operation cash flow is the profit, the cash profit, that is after adding depreciation and all that, and after paying after investing money on the working capital that is required, and after paying interest and taxes, the balance is what we call the operating cash flow. So remember that one. Whenever the examiner talks about operating cash flow, it is the profit, the cash profit, that is after adjusting for depreciation and all that, minus any additional investments in the working capital, minus taxes paid, and minus interest paid. So that is the money that the company has really generated from your operation. The balance money can come from, by borrowing money, by taking money from the investor, by going for share capital and all that. But that is not money that you have generated. You are not internally generated. It is externally generated. So the operating cash flow is a very, very important one. If we can find that the companies are generating enough cash, that means they are doing fairly well, healthy. If they are not generating enough operating cash flow, that means either they are making losses or they are making lot of investment in the working capital, not having enough money for a growth. So then there's something called, at this stage, you can just note it down. I will send you a note on this area. Free cash flows. What is free cash flows? Free cash flows. Operating cash flow is one thing. Another thing is what we call a free cash flow. Free cash flow is basically, out of that operating cash flow, you might decide that you want some money for further capital investment, to invest in property, plant and equipment. You have made operating cash flow of 200 million, but out of that you want to invest in your property, plant and equipment 125 million. Now after investing that money also, whatever that is available balance is what we call the free cash flow. It is freely available. Freely available. And if it is freely available, normally what should you do? After making all the investments, if you have still more cash, what should you do as a prudent director of a company, Majed?
You put in the retained earnings.
You pay a dividend, isn't it? After investing, whatever the money, the free cash flow is available for dividends. There's nothing Nothing that you can do with that money because you have done everything what you wanted. You have invested in the working capital, you have paid your interest, you have paid your taxes, and you have invested on the property, plant and equipment. The balance is the free cash flow. And that is a good indicator how much dividend that the company can pay. So this is what, as an analyst, when you take the financial statement, this is what you will prepare. Right? The examiner might ask you, this can come up in your strategic case study. Not too much of calculations, but they will ask you to describe the or to talk about the operating cash flows and the free cash flows. So these are some of the questions that we might have it later on in our this thing. Management. In fact, I think the biggest people who are concerned with the ratios are the management. That's the people who are working inside the company, the people who are managing the thing. They probably want to know how much gross profit we are earning, how much our margin, how much my asset turnover. So these ratios are very, very important. I'm going to look at some of these ratios to refresh your memory in a moment. Suppliers, they will be concerned with your payable days particularly and the liquidity. So they also will be probably looking at your operational cash flow, because will they have enough money to pay me as a supplier? So they want to look at, and they will be interested in that kind of a thing. So these are some of the people who will be interested. Now, having said that ratio is a very, very good tool, there are certain limitations. So famous examination question, the limitations of ratio analysis. Number one, availability of comparable information. Now you told me that you probably comparisons with the other company. Particularly when you are comparing with other companies, the comparability can be somewhat questionable. We don't know how they have prepared their financial statement. We don't know the basis on which they have prepared. So to compare with another company and to come to conclusion, you have to be very, very careful. And this is your skill. This is your skill. Not to take blindly and work it out and say, oh my gosh, we are good or we are bad. You have to do a thorough comparison. And most of the ratios are historical. It is the last year, the previous year, and the previous year. Yeah? And the history may not be what the future is. What the future is. So the future can be totally different from the history. The environment would have changed, the management would have changed, the new things would have changed. Sri Lanka just had the presidential elections, just completed the election, and they have just declared the winner. The incumbent president, going by the past analysis and the past historical data, he decided to go for elections 2 years in advance of his term. He should have waited for another 2 years, but looking at the history and looking at many other things, looking at the astrologers in these countries, he went for election 2 years ahead. But it proved to be a disaster for him. The opposition candidate won the election today after about 20 years, and that is purely history is no relevance. He went by the historical voting pattern and all that, but the history was not relevant today. The people wanted a change, people had voted for a change, and things are going to change here. Why? That is, the history is not relevant. So sometimes, even when you are interpreting the financial statements, you have to be careful. Why? Because maybe the earlier management is not there any longer. So for you to think that, okay, last year they made so much, and this year also they will make, and next year also they will make, may not be good. Information may be out of date. Information may not be relevant. And also, you need a very, very careful interpretation. And accounting policies can distort your financial statement comparison. Even in the same company. Same company. Last year you would have provided depreciation on reducing balance method. This time you would have done it on the straight line method. Last year you have gone on revaluation method. Year before last you went on historical cost basis. So many things can distort it. So it's one of the skills for you to do a comparison or to make the right adjustments before you go for comparison. Ratios could be manipulated. How can it be manipulated? Particularly, we remember in our younger days of accounting, we learned something called window dressing. Have you heard the word? Window dressing? Yeah. That is, you try to dress the statement of financial position just before the end of the financial year. So you will try to reduce the debtors, or look at the banks before the 31st December. They will give calls and say, please settle the balances. I will give it to you back on the 1st of January. So by that, they try to keep the balance sheet tip top on the day of the closing. So they might even go to the extent, some of these companies are so unethical, so manipulative, they might even put a fictitious invoice, put a big sale, show a big receivable, good performance for the year. Next day morning or 2 days after the next day morning, they can reverse the entry. I have seen this happening in my own company in a different way. The sales reps, when they have a target to achieve, you know what they do? They will, at the end of the month, they will raise some fictitious invoices and put up the sales. So we are happy, they are happy, everybody is happy. After 5-6 days, you find lot of things coming as sales returns. So they are clever fellows. They know how to manage, how to manipulate it. So ratios are definitely could be manipulated. And they are not very definitive. The way that you work out the ratio and the way that I work out the ratio can be different, Majed. One ratio that there's a standard is, what is the ratio? There's one ratio with accounting standard. What is that ratio? Any idea?
I'm not sure.
Earnings per share. Earnings per share. There's IS 33. That is the only ratio that the accounting is defining and telling how the ratio should be worked out. All the other ratios, it's your will, my will, the way that I do it, the way that you do it. Even the gearing, now I said gearing is debt divided by debt plus equity. Some people, gearing, they work out debt divided by equity. That's also right. There's nothing wrong in it. So people can have different ways of ratios. Then accounting loopholes. There can be, particularly you will remember in the leasing, we have these operating leases and financial leases, right? So we can define it in such a way we can say this is a financial lease and take it into our balance sheet. Or we can say no, this is not a financial lease, this is operating lease, and you can do it. I remember a long time back, I was working in a company, or the National Water Board in Sri Lanka. When I went for the first time, they were preparing the financial statements and they were showing big profits. Because the moment you show profits, the director, not the directors, all the employees, they get a big bonus. But the very first time when I went and prepared the financial statements, I ended up with a huge loss. And the workers were really behind me, and they were really threatening me, saying that I have prepared the wrong set of accounts. But I was sure that I prepared the right set of accounts. But my predecessor, what he had done is, he has prepared the accounts just to satisfy these fellows by not providing depreciation. Because depreciation is a huge amount. So he had not provided for depreciation, and he was preparing the financial statement, showing big profits and paying big bonuses. But when I prepared, it ended up with a huge loss, and the workers almost went on strike. So, but that is what the accounting loopholes can do. So you can show big profits, and you can declare dividends also, you can declare bonuses also. But the accounting standards you may be violating. So there can be lot of limitations on the thing. So I want to discuss the ratio categories. There are 4 main categories of ratios: profitability and return. Profitability and return. Now this is the ratio mostly the management will be concerned and the investors will be concerned. The return, how much return you are getting, and the profitability. The second ratio is debt and gearing. This ratio, right? This ratio mostly it will be focused of the lenders and the suppliers maybe. Liquidity ratios. This is a ratio that surely the lenders, the management, and even the suppliers will be concerned about. Then we have the shareholder or stock market ratios. So broadly, these are the 4 kinds of ratios that we might find in the world. Profitability, debt and gearing, liquidity. I mean, this is not a universal categorization, but surely these are some of the ways that the ratios can be worked out. So I want to look at some of these ratios in fairly detail. I mean, I'm sure you know some of these ratios, right? But I want to just to briefly touch it. Return on capital. Now, companies might say we have made a return on capital of 25% or 20%. What does it tell you? When a company says that they have made a 20% return on capital, so that means what it tells is for every $100 that is invested inside the company, a company is making a return of 20. That is what it says, right? A company is making a return of 20%. It means for every $100 investment that you are making, a capital investment of 20% or $20. So that is calculated profit before interest and tax. Now this is very important. Profit before interest and tax. Profit before interest and tax belongs to whom and whom? The profit.
Sorry, could you say?
Yeah, the profit before interest and taxes, it belongs to whom and whom in the organization. Profit before interest and taxes.
Not sure.
Yeah. Now look at try to visualize your profit and loss statement, Majed. You start with revenue, then your cost of sales, then you come to gross profit, isn't it? Yeah. Revenue.
Yeah.
Then cost of sales.
Then you come to your expenses.
Then you come to your expenses, establishment expenses. You have your selling and distribution. Then you have something called operational profit. From there we deduct our finance charges, and then we arrive at profit before tax, and then taxes, and then we arrive at profit after tax. So actually the profit after tax belongs to shareholders after paying every year. So profit before interest and taxes, that is what we call the operating profit mostly. It belongs to the lenders because from that profit we have to pay the finance charges, and it belongs to the shareholders, and it belongs to the taxman, right? The profit before interest and taxes is belonging to the shareholders and to the lenders. So that is what this is, profit before interest and taxes. And who has provided the capital for that? The capital for that has come from equity holders and the lenders, because the taxman has not provided you any capital. He is only going to take your money. So the equity holders plus lender. So the capital employed is equity plus interest bearing loan. To whoever you have to pay interest, you have to, that is your profit, the capital employed. So remember that one. So sometime you will see in your balance sheet or in the financial statements on the equity plus liability side, you have non-current liabilities. Surely on that we are going to pay interest, right? Then sometimes on the current liabilities you might have an overdraft, and on the overdraft also you are paying interest. So this profit belongs to the equity holders, to the non-current liability lenders, and also to the overdraft lender. So some companies, they might take as capital employed the non-current liabilities, equity, and the overdraft. Some companies, they might ignore the overdraft. Either way it is right. Either way it is right. But last year if you have worked it out on one way, this year also you must work it out on the same way. The argument is the overdraft is a very short term measure. But you might find in exam overdraft is a permanent one. And in that case, I think it is right to take as capital employed the overdraft part also, because that's almost a permanent capital, even though we show it as current liability. So what I'm trying to explain is how we are going to work out these ratios. Then the next ratio is return on equity. Return on equity. Return on equity is the profit after paying interest and taxes that is belonging. Now that belongs to whom?
The shareholders.
That belongs to the shareholder, return on equity. And that has to be divided by value of equity. Value of equity. Now value of equity It can be the book value of equity. So the book value of equity is the share capital plus reserves. The what you find, that is what you call total equity, the share capital plus reserves. But sometimes, and most of the time in FP, the value of equity is not share capital plus reserves, but the market value of equity. What is market value of equity? Market value of equity is, if it is a listed company, we have a share price, number of shares into the share price. Number of shares into the share price. So no, you don't take into the account the reserves, but that is the market value of equity is number of shares into share price. So if you have 10 million shares in the company and the market price of the share is 670, your total value of equity will be 67 million. 67 million. So that is the value. Or otherwise, they will. So it depends on what the examiner is asking. So look at for that one very carefully when we calculate it. Value of equity at book value or value of equity at market value. Now, profit margin. Profit margin is profit before interest and taxes divided by revenue. That is what is called operating profit divided by revenue. What is it going to tell you? Profit margin. When we say our profit margin is 20%. What is it going to tell us? Profit margin is 20%. That is, in other words, what
20% of your revenue.
Of your revenue is your profit, isn't it? Right? The profit is 20, revenue is 20% or the $20. For every $100, you have a $20 revenue. Now another ratio that you probably have come across is the gross profit ratio. What is the gross profit ratio?
It's gross profit divided by revenue.
Gross profit divided by revenue. So obviously the gross profit divided by revenue will tell us for each $100 how much revenue we are going to make. So obviously the gross profit ratio, if this is 20%, gross profit ratio will have to be much more. Right? So maybe the gross profit ratio is 35% and profit margin is 20%. What has happened to the 15%? What has happened to the 15%? You earned that.
It's gone through.
Yes?
The cost of sales.
Yeah, no, cost of sales is because the gross profit you arrive after cost of sales. You remember? Right? The revenue minus cost of sales is your gross profit, isn't it? So when you say gross profit, it is the cost of sales already taken in there. So when you say actually 35% gross profit, that means you are spending 65% on your cost of sales. Right? For every $100 revenue, you are getting 35 gross profit, means you are spending 65 on your cost of sales. Clear?
Yep.
Right. So from the 35, you are coming down to 20. Where is that 15 going? Look at this little statement what I put it up. From your gross profit, what are the two expenditures that you have deducted? Establishment expenses, selling and distribution expenses. Correct?
Yep.
So that 15% goes there, Majed. 15% goes there. And you end up with a 20% margin. That is what. So another company, for example, your competitor is also making the same GP, shall we say 35%, but he is ending up with a profit margin of, how much? He is ending up with a profit margin of, he is also going with the same 35%, but he is ending up with a profit margin of 15%. You, with a 35%, you are ending up with a 20%. What does it tell you between the two companies? You, with a 35% GP, is ending up with a 20% margin. The other company, 35%, but they are ending up with a 15% margin. What is it telling you?
It's telling you that one of the companies is maintaining its cost better.
Yeah. Yeah, right. The other company,
So
the other company,
like cheaper.
yeah, right. The other company seems to be spending more on cost than your company. Because out of 35, you are retaining 20, spending 15, but the other company is spending 20, retaining 15. So the other company's cost management seem to be not so good. Yeah.
Kumar, can you just hold?
Yeah.
Can you just hold on for one second?
Sure. Right. Okay. Yeah. So basically, what I was trying to tell you was this ratio will tell us many things. How you are managing your cost against another company. How you are managing your cost of sales against another company. So between the two companies, you have a 35% GP. The other company has 40% GP. That means they are spending only 60% on your cost of sales, whereas you are spending 65% on your cost of sales. So the ratios will tell many things. Maybe from last year to this year, our GP margin has gone up by 5%. And that means we are, we are getting goods cheaper, or we are selling it at a higher price, whatever it may be. So the profit margin and the gross profit margin are two very important ratios. What is this ratio? Asset turnover ratio. Asset turnover. Asset turnover is revenue divided by capital employed. Right? So obviously, if you have a good profit margin ratio, that means that company is doing better, comparatively better. But what about the asset turnover? What does the asset turnover tell us? Asset turnover tells us for every $100 capital employed, how much revenue I'm getting. For every $100 capital employed, how much revenue. Now, if that ratio is going to increase and increase, it is good for the company. That means you are utilizing your assets much more better. So, if your ratio is going to be 20% and my company ratio is going to be 25%, that means I'm doing better with my capital employment. I'm going to generate for every $100 invested 25, whereas you are going to generate only 20. So, I want to bring a relationship between these ratios, right? So, return on capital employed. Return on capital employed is, right? You can see return on capital employed is profit before interest and taxes divided by capital employed. So, I want to look at that ratio in two ways. What is profit margin? Profit margin is profit before interest and taxes divided by revenue. I want to multiply that by asset turnover. Asset turnover. Asset turnover is what? Asset turnover is revenue divided by capital employed. So if I do that one, the revenue to revenue will get knocked off. Finally, what I'm going to get? I'm going to get profit before interest and taxes divided by capital employed. And what is that? That is the return on capital employed. So, what I'm going to tell you is the return on capital employed is made up of two ratios. Profit margin and asset turnover. Profit margin and asset turnover. So, if you want to improve your return on capital employed, every company should be trying to improve their return on capital employed. If you want to improve, you can improve it by increasing the profit margin. Or you can improve it by increasing the asset turnover. Ideally, by improving both, you will get a better return on capital employed. Right? Now, two companies may have the same return on capital employed. For example, 40%, 40%. Company A, company B. First company, maybe they get a 10% profit margin, but they turn over asset 4 times. So that is the 40% how they make it. Second company, they make a 20% profit margin, they turn it 2 times. Both the companies are making a 40% return on capital. But can you see, they are making it for 2 reasons. Company A, they are doing very well on asset turnover. They are turning it 4 times. Company B, they are doing very well on cost. They spend only 80%, whereas this company is spending 90%. They keep 20%, but they turn over assets only 2 times. So you can learn from both the companies. Company A should be trying to increase their profit margin. Company B should be trying to increase their asset turnover. Can you see the relationship? Yeah? Hello? Hello? Hello?
Yeah.
Yeah.
Hello, can you hear me?
Yeah.
Okay.
Yeah. Did you hear what I was telling about the return on capital employed, the relationship?
Yes.
That is, the return on capital is made up of two functions, the profit margin and asset turnover. So the examiner might give you two companies with two same return on capital employed ratio, but the reasons for their growth or the reason for the return on capital being same may be two different reasons. This company is doing very well on asset turnover. They are employing their capital very well. This company is doing very well on their cost control. So, for different reasons, companies can be doing better. Is it clear?
Yeah.
Right. Right. So in our analysis, this is what. So just because both the companies got 40%, we should not be happy. We have to see how they got the 40. Is it because of the good profit margin, or is it purely because of good asset utilization? Different companies. So in interpreting the ratios, you have to look at the risk factor. Now, you might be doing some business which is having a very high risk return. So obviously your shareholders will expect a higher return. So you can't compare my return with your return because I'm doing a very low risk company, right? Compare and say that, hey, I'm doing better. The risk factor comes into the account. Also the capital intensity. The capital employed. Now service sector, you don't have too much of capital. I'm doing all this tuition. What do I have? I have only a laptop and a headset. That's all I need. My capital is very little, but because my business is basically based on my intellectual knowledge. But to make this same earning, another person may be having some machinery producing some goods to sell. So can you compare my company and that company and say, oh, Kumar's capital return on capital employed is very high? No, you can't, because it all depends on the capital intensity. Certain businesses require capital. Certain businesses require property, plant and equipment. Certain businesses don't require. Look at a lot of the software companies. What do they have? They don't have too much of capital. They have few computers and they know what to do with. Look at INSEF.
Yep.
The INSEF, I don't think they have anything, right? Because the tutors have their laptops and all that, but they may be making a lot of money, right? But they are capital employed, maybe, I don't know how many percentage, because they simply may not be having any capital. But they do something, they do marketing, they find the students, and they give it to the tutors, and they make money out of it, right? So lawyers, look at what they have. Do they have capital? They may not have any capital at all. No property, no plant, no equipment. But it is they are using their knowledge and they are making money. But a factory, on the other hand, will have lot of capital. Capital on property, plant and equipment, capital on inventory, capital on receivables, all that kind of thing. And when you are interpreting the ratios, one thing you have to look at is the revaluation. Now, a company may revalue their property. Last year it was 100,000. This year they have revalued it to 150,000. So your capital employed has gone up. But purely, it's only a book entry. It did not increase your earning capacity. It just increased the capital employed. So last year you had 100, this year 150. And obviously, if you divide by 150, you are going to have a low return on capital employed. Say, let's assume the same profit, right? Last year also they made the same profit. This year also made the same profit. But capital employed has gone up because of the revaluation. Now, and for you to come to a conclusion saying, oh my God, our return on capital has come down is wrong because we are not comparing apples with apples. So the accounting policy on goodwill. Some companies they will annually review the goodwill and impact. Some companies will just keep it on. So all that can have research and development, right? Some companies may not incur any research and development. And just because they don't incur research and development and have a higher profit, we can't say they are doing better. Because the other company may have invested more on research and development and surely they are in better position to take the company forward. So this is what actually you did in your F2, but today we are looking at from more strategic point of view. Overdraft interest, as I told you, should I include that as capital employed or should I not? So all that will make a difference in your calculations. So the profitability ratio, I have already discussed the GP margin, that is the gross profit divided by revenue as a percentage, and the net profit is net profit divided by revenue as a percentage. Net, when you say net profit, it is profit before taxes. Profit before taxes. And the same GP margin, lower may reflect cost control issues, right? And also GP margin can change due to sales volumes. So these are good questions that can come up in your short questions. How the GP margin can vary. GP margin can vary when you have big sales volume. GP can vary when the sales value prices have gone up or down. GP can vary when the sales mix is different. Last year you sold some high GP products, little, but this time you have sold more GP products, little. Purchase prices, the cost of sales, production cost, right? Your labor cost has gone up. Now last week in our company, we have a little factory where we manufacture, and once the analysis was done, it was shocking because it said that last year they had a 40% GP and this year it is only 30% GP. Oh, huge shock for all of us. And we have to go into the details to see how come the GP has come down by 10%. So we asked a director concerned who is in charge of the factory come and explain it to the board meeting. So he came and he gave a good explanation. He said, look here, if not for my intervention, your GP would have come down to 25%. I asked why. He said there was a statutory wage increase. Statutory wage increase that has to be given, that was enforced by the government, and that was about 15%. So he said, in fact, he has saved some money to other expenses, and therefore, even though the 15% increase, he managed to keep it within 10%, which was satisfactory. But it's not going to solve our problem because we want a 40% GP. But now we are down to 30%. So that ratio analysis has opened our eyes. We need to increase it by 10% further. Now what can we do? That is what the ratio analysis is going to tell us. What can we do? Either we must increase the selling price, or we must try and see whether we can cut down cost on another area, something. So that man said, okay, you give me so much of money, I can buy a generator and I can save on my electricity. This is what the ratio analysis is doing for the company. Of course, you might find the GP, for example, you might find the GP for the last year was 30%, this year is 25%, no apparent reason, right? You try to find out that no, the sales price has not gone up, no, the cost has not gone up, nothing has happened, but my GP, which was 30% last year, is this year 25%. I don't have any reasons, no changes happen, so how can that happen? You should be able to explain your variances. You should be able to explain why it had moved from 30 to 25. Now you don't have any explanation. I did not increase my sales price, my cost did not go up, but my GP has come down according to the account. What could be the reason? Can you think of?
Increase in costs?
No, I say no increase in cost. I did not, my cost did not increase, I'm saying, right? I'm saying my cost did not increase, neither I did reduce my selling price, nothing. No reasonable explanation. If that is the case, the next conclusion I can arrive is either I have made an error in preparation of financial statements or there's a fraud. You got the point, right? If there is no reasonable explanation, that means that something has gone, something has evaporated. So that means it can be a erroneous accounting, wrong inventory valuation. Now these are the things the examiner is looking at. This is where the taxman is looking up at our GP ratio. By looking at the GP ratios, he can say whether we have prepared our financial statements well or whether we have manipulated the financial statements. You got the point? Right? So that is what the ratios are going to tell. Our ratios are going to tell big story which we normally not find in our financial statement. Which we will not find in our financial statement, the ratios can tell us. So we discuss the gearing in a little way. Right? The gearing is basically the ratio. So we are looking here more of the current ratio, the current assets to current liability. Current assets. What are the current assets? Inventory, receivables, and cash divided by current liabilities. Most of the current liabilities are trade payable, and that is normally not given as a percentage, but as a ratio. Traditionally, we thought we should have a current assets to current liability ratio of 2. That means for every $2 of current assets, you have $1 of current liability. That is what it means 2, right? But nowadays, it doesn't matter too much. In fact, we want to reduce the current assets holding. So the ratio can come down, but so long as you are comfortable, healthy, it's all right. What is the quick ratio? Can you remember what is quick ratio? Quick ratio is current assets minus inventory. Yeah, current assets minus inventory. That is your trade receivables and cash divided by current liability. Why do we calculate a quick ratio? Because the inventories are not quickly realizable. So we want to know for an emergency how much can we quickly realize. But these are very, I would say, very historical, sometimes unmeaningful ratios compared to what was 30 years, 40 years back. Because today, even the receivables are not quickly realizable. If you are given credit for 60 days, I'm not going to pay you, tomorrow. Right? So, these ratios are somewhat, it needs some updation. It needs some kind of reviewing compared to what it was traditional. Then the gearing, I said, long-term liabilities plus equity. Long-term liability divided by equity plus long-term liability. So equity could be book value, that is share capital plus reserves, or the market value, that is number of shares into the market price per share. So operating leverage is basically how much you are making as a contribution against your profit. So that tells us how much we are spending on. Hello.
Sorry, Kumar, I can't hear you.
Hello. Not clear?
Yeah, it's okay now.
Right, okay. Right, sorry. Okay, right. So, I was talking about the operating leverage. Operating leverage. What is operating leverage? Operating leverage basically tells us sales minus variable cost. What is sales minus variable cost, Majed?
Contribution.
The contribution as a part of your profit before interest and tax. So it tells us how much we are spending on our fixed cost. If a company is highly operating leverage, that means that company has lot of fixed costs. So in a downturn economy, they are not very flexible enough because still they have lot of fixed costs which they have to bear it up. And that is why most of the companies are going for outsourcing. So in a downturn, they can quickly remove the staff. Because otherwise when you have fixed cost, it's a problem. When the things are not happening, still you have your expenses, which is a concern for the director. So they will be more concerned about this operating leverage. Interest cover. So I told you the interest cover. What is that? Profit before interest and taxes divided by financial cost. It tells us how many times your financial costs are covered with your profit what we have. 5 means 5 times over you are saved. The lender is saved 5 times over. 10 means your lender is saved 10 times over. If it is 0.5, you are not safe at all. That's what it means. So, these are the ratios that we need to worry about. Then the working capital loan. This is a very, very important ratio. This tells us the receivable days. What does it tell us? It tells us how many days on average we are holding our receivables. Average how many days we are holding our receivables. So it is calculated closing receivables divided by credit sales multiplied by 365. So if the company says my receivable days are 60, that means we are giving credit for 60 days. 60 days. So last year it was 60 days. Last year it was 60 days. This year it is 75. Now that tells us a story. It tells us either we are not collecting money on time or our debtors are not paying us on time. Payable days. Similarly, closing payables divided by credit purchases into 365. Now remember, the examiner had been somewhat nasty sometimes. Now we look at this ratio by 365 if you are given 1 year's account. Right? But I remember one time the examiner gave 6 months account. So in that case you can't multiply by 365. You have to multiply by 180 days. So we can't memorize the ratios and go. We must know what it means. What it means is if it is total sales of 1 year, then you must multiply by 365. But if the total sales are for half a year, then multiply by half a year. So payable days. Inventory days, it could be raw materials, it could be work in progress, it could be finished goods. So sometimes these ratios are calculated, mostly it is calculated on the closing figure, but sometimes it is calculated on average figures. Average figures. Average figures means opening receivables plus closing receivables divided by 2. Why do you take sometimes the average? Because sometimes, as I said, the directors or the management can manipulate the figures that your closing receivables are kept low or kept high. So to avoid that kind of a thing, you smoothen it by taking the average. So generally, in a good company that is keeping up to the good accounting policies, I suppose you can take the closing one. So if the examiners ask for average, take the opening receivables and the closing receivables divided by 2 without taking the closing receivables one figure. But otherwise, take the closing figure and calculate it. So inventory days, when it says last year it is 30 days and this year it is 45 days, what does it tell us? It tells us we are holding inventory for more number of days. And if you are holding for more number of days, what does it tell us? It may be telling us that our stocks are not moving or we are building up stocks. So in the factory unit that I was just telling you, we found in the month of April we had 1 month stock, and by the time we came to August we had 3 months stock. We have 3 months stock. So we are building up stock. We are properly not managing inventory, properly not doing the sale. So all those is can. So remember the inventory days, you have to remember, if it is raw materials, you divide it by purchases. If it is work in progress, you divide it by cost of sales. If it is finished goods, you divide it by cost of sales, because the work in progress is valued at cost. Finished goods are valued at cost, but the raw materials are valued at cost of raw material, the purchases. Payable days, you divide it by credit purchases. Receivable days, you divide it by credit sales. So the examiner might give you cash sales so much, credit sales so much, take only the credit sale. Or the examiner might tell you total sales are so much, but the credit sales are 80%, then only take 80% of that. So these are little things which he can put us in trouble. So we have to be careful that we don't get into unwanted area. Right. So next one. Ratio should be interpreted considering lead time. Now that's a very important one. Right? You can't compare my company and your company and say, hey, Kumar's company, the inventory days are only 10 days, whereas our company, the inventory days are 30 days. You may be buying goods from America, and therefore there's a lead time for the goods to come. So you have to hold a fairly good stock. So you can't compare my stock holding and say, you know, we are not doing well. We have to compare with the lead time. How many days it takes for me to order the goods and come up. Seasonality. Right? During December time, your inventory days can go up because you may want to stock up. Quantity discount. Sometimes sometimes you may be paying your creditors early because to get that quantity discount. Competitor ratios. If when a competitor is giving certain credit, you have to be somewhat closer to that one. Now my competitor, generally they give 90 days credit, but I give 60 days credit. My reps are always fighting with me, saying that, you know, they are giving, but I say, no, it's all right. You give it 60 days and do your sale. So you have to compare with many things, credit control procedure, all that becomes very relevant. Now I come to very important couple of ratios, what we call the shareholder ratio. These are the ratios you and I will be interested as shareholders. Dividend per share divided by the market price per share. Now this is available only for a listed company. Why? The market price is available only for a listed company. So the share market price is $10, and you are getting a dividend of 2. So the dividend yield is 20%. That is what. So it is not the price what you bought the share what matters, but at what is the market price. So compared to my market price, I'm getting a dividend. So that is what we call the dividend yield. Dividend yield. So what is the next ratio we are having? Earnings per share, very important ratio. I told you this is the only ratio where we have accounting standard. Profit after interest and tax divided by number of equity shares. Now you remember in your F2 time you would have done this ratio. If the company has issued shares during the period, we take the weighted average number of shares. So let's look at some of those things when you are doing some calculations. Earnings yield. Earnings yield. That's a very important ratio for the investor. That's not comparing the dividend per share, but it is comparing the earnings. Because the dividend is what they pay for you, but the earnings is what they have earned for you. It belongs to you. So earnings per share. So earnings per share, maybe the company has earned $5, and on your investment of 10, or the market price is 10, as a percentage, it is 50%. So having earned 50%, the company decides to pay you 20%. So the company is keeping the balance money. That is what it means. Earnings yield, which is a very important share for the shareholder. He wants to know on my return, what is the return I'm getting on my share. Dividend cover. Now you can see the dividend cover. If you really look at it, is the dividend yield upside down. Dividend cover. Dividend cover tells us out of my earnings how much I'm paying as a dividend. Earnings per share is 5, dividend per share is 2. What does it tell us? Earnings per share is 5 in this case, but I worked it out. Earnings per share is 5, dividend per share is 2. It tells us 2.5. What is it telling us? Dividend cover. Just like the interest cover. What is it telling?
Yeah, they can pay they can pay dividends to
they are safe for the dividend for 2.5 times. So if you have a good dividend cover, you can be quite comfortable that the company is doing very well. Right? In a growth company, they definitely will have a higher dividend cover. So that is what it means. Net assets per share. That is the net assets. Net assets are total assets minus liabilities. That is the assets that belongs to the shareholder divided by the number of shares. It tells us in terms of assets of the company, what is the value of my share. So it gives some indication of my wealth. I have 100 million worth of assets and there are 100 million worth of shares in the company. So 100 million shares the company has issued. The company's assets are 100 million. That means they are $1 is their value of the company, or the share value, net assets. Now we come to a very important ratio, PE ratio. PE ratio. Again, you can see it is the opposite of earnings yield. Now this is a very, very important ratio. Now that is the market price per share. Market price. Who fixes the market price for a share, Majed?
The stock exchange.
Pardon? Not the stock exchange, the market, right? The market, the people who are buying, people who are selling, there's a price, there's a price that at what price you are going to willing to buy it. So the directors can't fix it. Actually, the stock exchange can't fix it. It is fixed by the market. So let's assume that the market price for share is 20 today. And your company's earnings per share, last year's earnings are, shall we say, 5 earnings per share. So the P ratio is 4. What is it telling you? When I say company's P ratio is 4. What is it telling us? 20 divided by 5. You are earning for a year on average $5. But the market is prepared to pay your share $20. So the P ratio is 4. What is it telling you? It tells us that the market is prepared to wait for 4 years to recover the capital. Clear?
Okay, yeah, got you.
Right? Because you are earning 5. So the market is prepared to wait for 4 years to recover the capital. So the market is prepared to wait for 4 years. So let's assume your company, the P ratio is 4. In my company, the P ratio is 8. What is it telling us? Between the two companies, which is better? Which is better? Your company, market is prepared to wait for 4 years. In my company, the market is prepared to wait for 8 years. What is better?
The one with 4 years.
One with 4 years is better, you think? Yeah.
Yeah.
Yes. Now I'm going to show you something. Let's assume both these companies. Both these companies. I want to pick up on this one because this is very interesting thing which I'm going to do it. Now both the companies are earning, right? Both the companies are earning $5. Your company is earning $5. My company is earning $5. Right? Both the companies are earning $5. Company A, the market is fixed in a price of 20. Company B, the market is fixed in a price of 40. Now, for a minute, I want you to forget about the price earnings ratio. Look at the two companies, company A and company B. Who is better? Which company is better? The market. Who has the market recognizes which company better?
B.
Company?
Company B?
Yeah, company B, because the company B, for the same earnings, like the company B, the market is prepared to pay 40. For the company A, the market is prepared to pay 20. Now come to the PE ratio. What is the PE ratio of company A? Price divided, yeah?
Yeah, so 20 divided by 5.
Fine, 4. What about the other company?
40 divided by 5.
8.
8,
Right?
yeah.
So now what do you say? Earlier you said the 4 is better. Isn't it?
Yeah, but with the ratio, it's with the ratio, go with company A.
Yeah, company A, right. Now, between the two companies, which is better? Forget about the ratio, which is better? B is better, sure?
Yeah.
B is better, right? The market is prepared to pay 40, so that means because both the companies are earning the same, but the P ratio of company A, B is 8, company A is 4. I want to explain this to you. What it tells us is, the market is prepared to wait in the company B for 8 years. But whereas in the company A, market is prepared to wait for 4 years. That shows...
Sorry, come on. When you say prepared to wait for 4 or 8 years, what do you mean?
To recover your capital.
To recover your capital.
Your capital. That means, what I'm trying to tell you is, in the company B, the market has more confidence to wait for 8 years.
Yeah.
Because they are very stable, their policies are good, you are prepared as an investor to wait for 8 years. But in the company A, because, not so good, you don't want to wait too long, you want to recover it fast. You got the point?
Yep.
So what it is telling is, you can note down, this is a very, very important one in the F3, which we are learning today in a new, that is very important thing. What I'm trying to tell you is, higher the PE ratio, better the company it is. Most of the time we think the other way about, but I want you to learn this thing. Higher the PE ratio, better the company it is. This is the fundamental theory for F3. All our calculations will be based on this one. Higher the PE ratio, better the company it is. That means, in the company B, the market or the shareholders are prepared to wait for 8 years because they believe the directors are good, company is good, good corporate governance, good risk, no risk, little risk. Whereas the company A, they believe they don't want to wait too longer, they want to recover their capital very fast. So they are prepared to invest only 20 when the company is earning $5. Whereas on the second company, they are prepared to invest 40 when the company is still earning $5. You got the point?
Yeah.
Yeah. That shows the confidence in the market of the company. Higher the PE ratio, better the company it is. And you can, and I can show it to you in another way. So the price earnings ratio is the market price divided by earning. So on the other hand, if you take at that is the PE is equivalent to price divided by earnings. So if you want to find the price of a share, it is the PE ratio times earnings. So higher the PE ratio, better the company it is. You will have a higher price. Same company, same earnings, 4. One company you might multiply by 5. Second company, 4, you multiply by 8. Whatever. So, sorry. Yep. So, higher the PE ratio. So, this is a very, very important thing that we are learning just now. The price earnings ratio, which tells us it's better. Every company should be trying to improve their price earnings ratio. How to improve it? They must improve their price. If they want to improve the price, what should they do? They must manage their risk very well. They must manage their corporate governance very well. That's the way company will do it. Then the final ratio is the return on earnings. That is earnings divided return on equity. Return on equity. Right? Earnings divided by market value of shares. Return on equity is earnings. Earnings is always when the F3 examiner or the F3 says earnings, it is the profit after tax. Profit after tax divided by the market value of shares. That will tell us as a shareholder what is my return on earnings going to be. So these are the couple of ratios which we need to learn all the time, and these are very, very important. Then the final ratio is total shareholder return. Now the shareholder gets return in 2 ways. One is the dividend per share and the other one is the capital gains per share. That is what we call TSR, total shareholder return. So let's assume that at the beginning of the last year, you invested on a particular share and the share price at that time was $10. And by the end of this year, the share price has gone up to 11. Right? And during this period, the company paid you a dividend of, shall we say, 50 cents. 50 cents. So your dividend per share is 50 cents. What is your capital gain? What is your capital gains? Originally, you invested 10. Now it is
by 1.
1. So total return what you got was 50 cents into your pocket and $1 increase. So total return you got was 150 on an original investment of $10. On original investment of $10. So your total shareholder return is 15%. 15%. This is what you will be concerned. How much dividend you are going to get? How much the capital gains? Sometimes you may not get any dividend, but the capital gains are, 20%.
Sorry, Kumar,
Yeah.
the figure there is that 1.5 that you've written?
And no, $1, 50 cents is the dividend.
Okay.
And the $1 is the capital gains. So the total amount that you got was 150.
Okay, and then divided by?
Divided by the original share price at the beginning, the share price is 10. 10.
Multiplied by 100, yeah?
100, yes, that's correct.
Okay, all right.
So on your $10 investment, you got a 50 cents dividend and a $1 capital gain, so you have got a 150 return. Got it? 150 return. So that is 15%. So that's what it means, the total shareholder. So these are the questions that your examiner can put it up on the short questions and ask you to calculate it. So, finally, let's look at a few things. The ratios. The ratios is a very, very important tool for forecasting. If you know that our inventory days are 60 days, and if you are going to maintain 60 days, we can forecast the next year's sales. So we can even do a forecasted statement of financial position, and so maybe in strategic case study level, we will be doing. So ratios are used to evaluate, ratios are used to appraise, ratios are used to do the forecasting for the future period. We may want to say that the gearing, we want to maintain it at 40%. So we know the maximum debt we can go if we want to maintain the gearing at 40%. So basically, I come to the end of this session now. That is the ratio. So what I would recommend is for you to go to the BPT textbook from page 39 onwards. Go down and read it and try to see it. So next week, before we start on our, I think we have some classes during the weekend, no?
Yeah, so we're going to do Saturday and Sunday.
Yeah, that's right. So we will be looking at some of those areas also this week. So tomorrow we are having a class, I think.
Yeah, I think Saturday morning, I think.
Yeah, we have a class Saturday and Sunday. Are you ready tomorrow? 9 o'clock we have put 2 classes.
Yeah, tomorrow should be fine.
Tomorrow we will do the corporate governance, and on Sunday we will do the financial reporting. Okay?
Okay.
So we will be,
so just so for the for this session, and then for the first F3 session, and then the one